do this. Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. Okay. Welcome, everyone. If you have any comments or questions that you want to pose, just type it in the chat and I'll take them. I'm very happy that our guest today, Graham Boyd, has taken the time to share with us the eternal question that is on everyone's mind. What the hell is ergodicity? If I pronounce it correctly. So Graham, if you can unmute your mic and also turn on your video, that would be helpful. There we go.
There we go.
Thanks a lot. So now, turn that. For those of you who are not familiar with Graham Boyd, those that are watching live and also those that will watch the replay, just briefly share with us who you are, what do you do, what's your big purpose, and what the hell is ergodicity in a kind of idiot proof that I can even understand it. And I'll go on mute and turn off my video so the focus is on you.
So who am I and what I'm up to? So I began life in South Africa, studied physics originally, and my PhD thesis was on non-ergodic dynamics in particle physics, and worked in physics for a while as a researcher around the world, joined Procter & Gamble, worked in Procter & Gamble for 10 years, and left P&G in 2008, basically saying something is seriously wrong if a company whose purpose is to improve the lives of the world's consumers is still developing more and more products that are actually exacerbating climate change, biosphere degradation, and everything. So the center of my focus for the ever since then has been on really uncovering what are the deepest level root causes rather than the more surface level causes of why we have an economy that so far we haven't been able to get our economy to be healthy for life on the planet. And we've had all of these really good initiatives. Triple bottom line is one of them, the whole sphere of impact investing, regeneration, etc. But from my perception, compared to the scale of the problems, the speed of climate change accelerating, the speed of resource degradation, biosphere collapse, and everything, we're falling further and further behind where we need to get to as time passes, despite huge efforts from good people, capable people, skilled people in all of these arenas trying to address the problem. And so that's at the heart of what I'm up to, is uncovering the root causes. And we do that in the sense of A, building solutions, B, demonstrating that the solutions work through our startup clients, through our accelerator program, and finally by offering training programs, workshops, and consulting to investors so they can deploy solutions to these root cause problems. And that's where ergodicity comes in. And I'll unpack more and more what ergodicity is as we go through this. I'll caveat that, though, by saying what really matters is what this means in practice. What should we be doing differently, rather than the strict definition of what it is? Because the strict definition of what ergodicity and non-ergodicity is deeply mathematical. It's deep inside statistics. So in a sense, I can only explain it in equations in ways that are really solid. But to put it, a couple of simple takes on it. The one simple take is there are two types of, if anything is changing in the world. In other words, when you look at something, how does it change over time? How capital grows, how it decays, for example, whether that is financial capital or biomass on a pond. As soon as randomness comes in, that growth process is always in one of two classes. It's always an ergodic growth process, or it is a non-ergodic growth process. And up until very recently, economics, modern portfolio theory, business strategy, business thinking in general has been completely blind to that distinction. It hasn't recognized that there are two completely different types of capital growth processes out there, and they require fundamentally different statistics to predict what we should expect from a business or an investment in the future. Now, I'll go into a bit more depth on that and unpack it more as we go through this. The key thing to take away from what I've just been saying is that this, let me say, ignorance of the existence of two different types of growth processes is a big reason behind companies going bankrupt, behind the externalities we're dealing with. In other words, why we even need to have impact investing in the first place as a distinct category. And until we treat both of these classes correctly, and we correctly identify what's happening, nothing that we're doing in the world of business, in particular impact investing, to try and generate good outcomes for life, none of that is really going to work at the level we need it to work. And so if I dive into that a bit, and Robert, feel free to interrupt if you want to guide me in any specific direction.
I would, if you can make it, I mean, the financial sector is just a bunch of predictable alpha males who run up the cliff and off the, run up the hill and off the cliff at the same time. So how will what you're saying help them achieve alpha? Because that's all they live for, is showing performance.
Let me rather show rather than talk. Do I have screen sharing permission? If you could enable screen sharing. Right. So hopefully everybody can see my screen. What you're about to see is a video. The vertical axis are the cumulative returns across a portfolio. The horizontal axis is time in months. So this is looking over 10 years. And what you're seeing, each of these different colors is a group of companies that have been invested in. The dashed lines is a group of companies invested in using conventional modern portfolio theory. The solid line is invested in full respect of this distinction between ergodic and non-ergodic capital growth processes, using a strategy to maximize the outcomes of the non-ergodic growth processes. Whereas the conventional strategy is blind to this, so modern portfolio theory actually does not do a good job of what it promises of delivering a balanced risk-return portfolio. And so what you're going to see is, as time passes, initially, the conventional portfolio is ahead of the ergodic ecosystem investing strategy. At this point, one of the companies in 3 of the portfolios went bankrupt, and the conventional strategy dropped below the ergodic strategy. As time progresses, that conventional stays ahead until here, where the ergodic takes over, another bankruptcy. And so from around about here, it's really clear that the ergodic approach is consistently outperforming the conventional, and it's giving a much, much tighter spread of the cumulative return. And if we keep going, the key thing to notice is that here you have companies going bankrupt, whereas in the ergodic approach, those companies do not go bankrupt. And these are bankruptcies that have nothing to do with the quality of the product market fit or the leadership team or anything like that. They're caused by a random shock coming in, like COVID, for example, that was simply bigger than the reserves that the company had to absorb. And that doesn't kill them in the ergodic approach. And if I go to the next slide, what you're seeing here, this gap in returns from an ergodic investment strategy versus a conventional portfolio investment strategy, that gap will either investors can pocket that as simply better return on investment. More effectively, though, for impact investors, this means that they can still take out the returns that they currently expect to get from a standard portfolio investment, and that balance can be invested in impact and all kinds of other things. In other words, it's removing the trade-off between impact outcomes and financial return outcomes. And so, for example, if somebody is running a philanthropic foundation and they have a 95-5 split, 95% of their money is invested in the conventional stock market and 5% is invested in philanthropic activities, well, this gives them the opportunity of putting 100% of their money into impact investments following an ergodic strategy that deliver the same kind of healthy return that they would get as per these dotted lines from a conventional portfolio, and that deliver impact without any compromise. And the last 2 things I'll put in answer to your question there. If you think about in the startup world, around 1 in 10 startups really delivers returns for the investors. It's the rare startup that carries the VC fund rather than the typical startup. And similarly, statistics that I saw recently around VC fund performance, prepared by an Israeli VC, suggested that 50% of VC funds that he surveyed delivered less than a 1x return for their LPs. Another 45% delivered between 1 and 3x, and only 5% of VC funds delivered more than 3x returns to their LPs. And 3x is the minimum, in his opinion, to bother putting your money into a VC fund as an LP. Below 3x, you're better off putting your money into more conventional investments. So the real reason why this is critical for investors to understand is that this is a very, very deep level root cause that leads to many of the superficial causes that are currently attributed to or as causes of business failure and investment losses. And without addressing these root causes, we're not going to get what we're after. As Nassim Taleb puts it, this is a way of getting both alpha and beta strategies to work together. So it's a way of getting more alpha and having a tighter spread as a beta strategy. So let me stop sharing at that point and come back to here. Let me dive a little bit deeper into what this whole ergodicity question is. Imagine that I go to a village of 1,000 people in the village, and the average wealth of the village is such that each of the villagers has 1,000 euros. So that would be €1 million is the total wealth of all 1,000 people in the village. So I go to the village and I offer them, each person, a single game of Russian roulette. And I say to them, if you survive, you'll get €1 million from me. If you die, I get all of your wealth. Now, the village might well decide that this is a good opportunity. On average, they can expect to get, at the end of one round, 830 million euros will come into the coffers of the village. And they may well decide that that is worth the risk of 170 of them dying and me getting 170,000 euros from those villagers. Now, as a side comment, this is pretty much the decision that people take when they go to war. When they are attacked and they decide to defend themselves, they know that some of the people are not going to come back, but their hope is that those who don't come back, the sacrifice of their lives will lead to a significantly better life for everybody that survives. So in a situation like that, there is a rationality to choose to play Russian roulette, because you know that at the end, you will have typically 830 million euros in your coffers. Maybe it will only be 800 million. Maybe it will be 900 million even. It'll be somewhere in that range. However, if I were to go to one person in that village and offer them the Russian roulette game 1,000 times in sequence, and they have to play it 1,000 times in sequence if they commit to start, they are almost certain by the 10th time to have hit a live round, to have passed away, and I will have regained everything that they got from me during the first few rounds where they survived. Modern portfolio theory does not distinguish between these two outcomes. Modern portfolio theory, economics, business theory, says that it doesn't matter whether we do this 1,000 times in parallel or 1,000 times in sequence. And by saying it doesn't matter whether we do it 1,000 times in parallel or 1,000 times in sequence, when we're doing business plans, when we're taking investment decisions, we look at what is the average outcome if we do it 1,000 times in parallel, and we then use that average to predict the typical outcome we'll get in the future if we do it 1,000 times in sequence. If there's a difference between doing something 1,000 times in parallel once each, or one person doing it 1,000 times in sequence, if there is a difference, that is non-ergodic growth dynamics. If it's identical, that is ergodic. Almost everything in the world of life, in the world of business, is non-ergodic. And the key thing is that any non-ergodic process, the typical outcome, if you keep going for long enough, is always worse than the average outcome where you're averaging over, say, 1,000 times in parallel. And this is why this is so critical. This is beyond everything that everybody knows. This is a very little known, deep foundational root cause of business bankruptcies, of investment losses, driving externalities, driving the need for impact investing. This is deep behind the root causes of everything that's happening. So maybe let me pause there. Robert, do you want to pop back in again, or shall I keep going with something?
Yeah, I had a question. If this methodology or theory, and you're linking it to impact investing, but you still have to select investments based on their sustainable impact. What are you doing along that? You're using a process, but what are you doing to select investments that are actually more climate positive, let's say, or more climate benign?
So 3 responses to that question. First of all, the whole theme of capital growth processes are non-ergodic. Ignoring that is a key root cause driver of needing impact investment in the first place. If portfolio theory, business strategy, economics fully respected the non-ergodic nature of business, we wouldn't have the incentives we have to try and push costs into externalities. To put it simply, we build businesses that we build businesses that are going to go bankrupt. And then we try to push all of the costs outside the business to just keep them alive for long enough to get some money out. So that's the first thing. Then the second bit is what I'm talking about complements everything that good impact investors are already doing to maximize the impact that a business can deliver. In a sense, what I'm talking about is, let's say this is an underlying paradigm that can be used for all kinds of outcomes. And it's up to the individual investor to then bring in addition, their preferred theory of change, their preferred impact approach to use this ergodic investment strategy as a way of getting more impact from the same investment. And then the last thing I'll say, though, is that this this ties very tightly into the emerging work, for example, by Transcap, around the whole necessity to look at impact investing through a systemic lens rather than an ad hoc lens. And the ergodic strategy works at its best when you're working with a diverse ecosystem of impact companies that all interlock with each other, and where you invest in the ecosystem as a whole rather than into any individual businesses. So that's also a key takeaway from this, which is that to invest in an ergodic strategy and to maximize the impact of the investment and the returns, we need to give up on investing into single companies. In conversations with John Fullerton about a year ago now, John said to me, Graham, I think I get it. Are you telling me that investing in single companies is dumb? And I said, yeah, absolutely. That's one of the key messages. We need to invest in ecosystems of companies at one go, or in a circular economy perspective, we need to invest in the entire circle, not in individual businesses in the circle.
But that's what, I mean, there was what's his name? Buffett had a bet with these algorithmic, nerdy geniuses. I'll bet you, I think it was $1 million or 5 million, that you will do your fancy selection with all your algorithms. And I'm just going to buy the cheapest index fund that exists, buy the whole thing. And I think it was a 10-year bet. And he beat Buffett won at a large difference, very large difference by bet. And he said to his wife, when I die, do not invest individually, just buy the cheapest index that's out there.
Yes. So Buffett is absolutely spot on with that. And this ergodic investing strategy takes his value investing strategy to the next level. You can think of ergodic investing as value investing 2.0. So investing in an entire fund is getting some of the benefits of an ergodic strategy at the level of the investor, but it's leaving value lying on the table at the level of the business operations and business growth. And you saw that in the graph I showed you a moment ago. The investing as a portfolio into individual companies, you're still doing better by investing in the largest possible portfolio, which is an index fund on the stock market. If that all of the companies in that index fund are bonded together in an ecosystem, and you're investing into an ecosystem holding company, and then the ecosystem holding company invests in the individual companies, and within that ecosystem, you're using all the different mechanisms to counteract the losses caused by the non-ergodic dynamics of business, then you increase even more the power of index investing. In a sense, you can think of this, our current way of investing on a company by company basis is extremely leaky. It's as if we're trying to get water from a river to put out a fire a kilometer away, and we're carrying that water in a colander, and we're doing our best to find colanders with fewer holes in them and trying to run as fast as possible to get there before the water disappears. Whereas ergodic investing, you can think of as something like, by putting all of the companies together into an ecosystem, you have a whole nest of, say, 100 or 1,000 colanders stacked one on top of each other, all at slightly different positions, where the whole of one colander is blocked by the solid metal of a second colander. And so that really eliminates all of the unnecessary capital losses that are driving many of the bankruptcies that we see today.
So if we took this for private equity, investing in fund of funds is the best thing you can do.
Investing in a fund of funds in today's world is the best you can do from the investor perspective. And the insights into ergodicity give you a performance boost beyond what you could get today in a fund of funds. Because in the fund of funds, you're still not changing the capital growth of the individual companies. You're getting some level of hedging at the fund level, but you're not changing the dynamics of the individual companies. And to dive into that a bit, the things that will give you a better strategy in terms of an ergodic strategy to increase performance, the simplest and the easiest is to have at least 5 times more cash on hand. Now, Warren Buffett does this very well. He's, from the beginning, has always had a far bigger chest of dry powder than almost any of his peers, because he understands, at least intuitively, and he talks to people like Nassim Taleb and Mark Spitznagel and so on, so he knows about ergodicity. The bigger your chest of dry powder, the lower the risk that some shock is going to come your way that kicks you out of the game, and the bigger the chance that when an opportunity comes your way, you have the dry powder you need to grab that opportunity. So that's the first one. We need to run companies much, much fatter than we do at the moment. And that gives you maybe 10 to 20% of this ergodic strategy boost. The real boost comes when you do what used to be very common in business in the West is still very common in business in Asia. And in some ways is quite common in many businesses still today. If you look in Asia, you have a lot of conglomerates. The Japanese keiretsu, the Korean kaibol. If you look in modern day business in Europe, in the US, again, you have large multinational conglomerates that have a wide range of products that all come together into one top-level P&L account and one listed company. And the share price of the listed company is the integration of all of the profits and losses of all of the different brands and business units and countries. This was standard historically in many older businesses, and you only have to look in Europe at the Hanseatic League. And Amsterdam was one of the primary cities in the Hanseatic League. Again, the competing merchants in the Hanseatic League used to pool their profits in terms of sending the ships out and getting the goods to sell back in, and then would compete on an individual pricing level. And this is the secret of really doing a fully fledged ergodic investment strategy at the company level, is all of the companies in the ecosystem commit to putting a certain percentage of their profits each month into a central pool that is used to keep the ecosystem as a whole healthy. And in the simplest case, the money goes into the pool and is immediately sent out again to all of the other companies in the pooling mechanism. And this is something to go into a completely different field. Professional poker players do this. Professional poker players usually come together into a syndicate. They calculate the expected winnings of each of the players. Any winnings that are above the expected winning go into a central pool, which is then shared out again to all of the poker players. And what that does is it maximizes the winnings of each individual poker player over the long term. So their typical winnings are maximized over the long term. And part of how it does that is that it keeps all of the poker players in the game all the way through until the end of the syndicate's lifetime, versus the way poker would be played if you were playing it individually. Because of the big fluctuations, the big randomness involved, no matter how good you are, sooner or later there's going to be a game that bankrupts you. Even if you use the Kelly criteria to perfection, there's still going to be a game that will bankrupt you, that will kick you out of the game, and you can't come back in again. And that will happen regularly to everybody. Whereas by syndicating, everybody stays in the game. So that's the key. But in addition to index funds or investing via a VC fund and then stopping there, the ergodic strategy goes deeper to the level of the individual companies and says, all of you individual companies, use a blend of competition and collaboration where you're doing some level of fractional profit pooling, which prevents people getting kicked out of the game just because they got unlucky, just because there was a random shock like COVID that kicked them out of the game. So let me pause there and see if there are more questions. I can also keep going.
Well, I had a question. You said that, which I'm not surprised. You said from one, I think it was Israeli research, they found that 50% of the VCs had only 1x, 45 had 1 to 3x, and only 5 had 3x, which is what they were trying to achieve. I'd be curious if the 5% were the tier ones, or they were just, one of the other one, because who among the VCs use your ergodic methodology or concept in their investment, and are they doing a better job financially, or has no one implemented your story?
Right. So what I'm talking about is, for example, this is a core part of the strategy of the hedge fund Universa that is being run by Mark Spitznagel with Nassim Taleb as key advisor and co-founder and guru. So they use this deep understanding of ergodic versus non-ergodic dynamics as part of their white swan, black swan, fat tail hedging strategy. However, the typical VC funds are pretty ignorant of this, are still investing in individual companies rather than profit pooling ecosystems. And so to a first extent, none of them are actually using this ergodic strategy consciously. However, it is showing up in one well-known rule of thumb in the VC world. So the rule of thumb in the VC world is that if you're not investing in a large enough number of startups, the chances of your hitting a 3x or greater return is very small. And that is the outcome to be expected if you're investing in a non-ergodic world and you're blind to it. Because the key message of the non-ergodic world is that the typical outcome for any single business is going to be significantly below average. The average is dominated by the very rare lucky case where somebody plays Russian roulette 1,000 times in succession and comes out at the end of the 1,000 times still alive. That big win is the one that dominates everything. And so this really is, seen through an ergodicity lens, the key strategy that VC funds are playing is to just pray to the god of luck that one of the companies in the fund will strike it lucky and will survive the game of Russian roulette all the way to the end. And that's why the bigger funds, in part, tend to do better. And our approach is saying, no, we're not going to do investing with a strategy that is heavily dependent on striking it lucky and having enough firepower to invest in enough companies to get it lucky. We're going to use a consistent strategy to maximize the chances of every company that we invest in of thriving throughout the entire journey. Yeah. And by comparison, if you compare this to medicine, the way that we invest at the moment is somewhat comparable to the way that surgery was done 200 years ago. It was very much a case of luck and trial and error, and a lot of myths and superstitions that were not actually evidence-based. Whereas this is now, how do we do surgery the way surgery is done today, with a deep understanding of what happens? Or by comparison, we currently invest in and build businesses somewhat the way that we used to build cars 100 years ago, where you were pretty happy if your car managed to drive 500 kilometers between needing major repairs. Whereas today you get kind of unhappy if your car doesn't get to 20 years old before it needs major repairs.
I had a question here from Will. Could the multi-asset hedge funds be enhanced by enabling more interaction, credit and debit, between those assets, liquidity, commitment pooling?
Absolutely. That is the key. That's really the key of an ergodic strategy in action, is to have as much diversity as possible. At least it needs to be sufficiently diverse, and then having an appropriate balance between a competitive relationship between the companies in the ecosystem and this kind of pooling relationship. And that pooling can be across multiple dimensions, modalities, etc.
So I'm curious, I mean, I knew there's a lot of really terrible VCs and PE funds. Apart from performance, also many lack social skills. So why do they keep getting so much money? I mean, Adam Neumann committed fraud and 40 billion and then went bankrupt, jumped out with $1 billion. And now he starts basically the same company, but doing now retail. And Andreessen Horowitz throws him 350 million. So why are the LPs tolerating this? The pension funds and the family office, etc.
Yes.
If what everything you're saying is correct, and I'll take that at face value, why are they continuing to fund a system that is not working in their interest?
So there are a number of lenses to look at that through, but the first one is, if somebody has money and they think that what they're doing with their money is the best that they possibly can do with it, that this is the best game in town, it takes a rare individual to say, no, I'm not going to put any money into investing. I'm going to keep it under the mattress, or as Warren Buffett does, keep it in my dry powder chest for longer. So I think that's one part of it. The money is there. People want to do something with it. Maybe they have to do something with it. And the current approach to investing is all they know about. That then comes into a deeper reason. So, I'm a scientist by training and background, and the more I get to understand how economists, in particular neoclassical economists, think and work, the less science and evidence basis I see in economics, and the more economics looks to me like a cult rather than a discipline or let alone a scientific discipline. And I think that's another big underlying reason. And the whole question of is something ergodic or non-ergodic in physics is 150 odd years old. Economists could have brought this into economics at least a century ago. And there have been attempts to bring this lens into economics over the past 50 years. It's really only over the past 10 years that it's started to become worked on. And there has been a huge backlash against this insight from the, let's say, the mainstream neoclassical economics cult leaders to, push back against the whole thing. And in part because it challenges all of the theories that economists over the past century have built their career on. Yeah, and so that leads to the other side of it, which is, a little bit like this: don't kill the CEO's sacred cows in a company. If the CEO is very fond of a project, no matter how good or bad it is, it's probably going to keep going.
Yeah.
And a bit similar, in the old days, you had that saying of nobody ever got fired for buying IBM. Well, today in the investment world, nobody ever got fired for using portfolio theory to get a risk return balance.
So I mean, you've been doing this a while, I guess, I don't know, 10 or 15 years researching this. But it's not being accepted from the big boys except for a couple. What are you doing to change that?
Right, good question. So let me put a couple of things in. So one of the things we're doing is working ourselves on starting up our own investment fund that will invest using a maximal ergodic strategy to really demonstrate how we can deliver best-in-class impact and best-in-class returns simultaneously by doing this kind of investment approach. And yes, that there is definitely a level of apartheid in there. Good comment, Marie. So that's one of the things we're doing. At the other end, we're offering various training programs, from training programs that are specifically for investors. So for example, I'm just going to paste up a link into the chat window. We're busy finalizing the design of a 1-year-long training program for investors, and including if I think of a family office, you have the principals and you have the actual professionals in the office. So this is a training program for those professionals and the principal to attend simultaneously, to help them get to the point of really understanding how the principal's ambition to do regenerative investing can be done in a way that also satisfies the office's mandate to preserve wealth for the family office. And then we have a lighter program for investors, which I've just popped the link up, which is a 5-session introduction to this whole thing for investing. And then we also have for for entrepreneurs and for everybody who wants to understand this, our Ergodicity 101. And the bit I'll add in here, I've spoken a lot about investing financial capital business. This whole question of ergodic versus non-ergodic processes in life applies as much to each of our individual lives as it does to any of the businesses. And for me, for example, by using the deeper I've understood what this means, the more I recognize just how big a role randomness has played in the path that my life has gone down. It makes it far easier to simply give up completely on all of those judgmental thoughts of, if I'd only made that choice 10 years ago, or if I'd only made this choice when I was choosing what to study at university. It recognizes that each of us only has one life to live, and all of these comparisons that we're making that leave us feeling bad or leave us feeling good, those comparisons are coming from a world where that roulette game of 1,000 times in parallel or 1,000 times in sequence gives the same answer. So it's very relevant to people's private lives as well. It's why human beings come together in societies, in communities, and why in communities there's high levels of collaboration and sharing of resources. It's exactly an ergodic strategy in action at a human individual level. It's why when you look at nature, most of the plants, animals, etc. in nature work at some level in collaborative communities. And in nature, these collaborative communities, it's not just a pride of lions that is collaborative within the pride. Even between, let's say, competing species in nature, you actually find far more collaboration and cooperation than most people imagine happens. And it's a core reason driver of multi-level selection in evolution, for example. So let me pause there. I can keep talking for hours.
We have a few questions and comments. Dana was saying, how many of the VC world have heard about ergodicity?
Absolutely not enough. This is something that needs to go out to everybody. Everybody needs to know about it and choose their strategy to do it, which is why I wrote The Ergodic Investor and Entrepreneur and published that a year ago to get this message out to more people in the investment world, whether it's a consultant, a principal, a professional investor, a VC, whatever. They need to know about it. Fortunately, over the past few years, people like Nassim Taleb have been writing about it. So the message is getting out there. Bookstaber has written about it as well in his book about the four horsemen of the econopocalypse. So the message is getting out there, but we don't have time. We have no time left. We need to get this message out there to everybody, because if we keep trying to, what we're doing at the moment is trying to deliver the impact outcomes we need by either trying harder or throwing more money at the problem. And neither of those are enough. They're necessary, but unless we also try differently with this ergodic strategy, we're not going to be able to get there.
Okay, I had another quick comment. Not Dana, Donna this time. And so, do we keep going off the cliff?
I hope not. if we can start deploying ergodic investing strategies broadly, in particular, if we can get a significant segment of the impact investment community, in particular, if we can get the LPs to mandate only investing in funds that deploy an ergodic strategy, if we can do that, we'll pretty quickly have clear data that these funds deliver better impact and better returns. And then that creates a snowball effect. But the time is tight. The recent research suggesting that 1.5 degrees is now unattainable, that the best we can hope for is a 1.6 degree warming, making completely clear that the current de facto strategy of significant carbon dioxide overshoot and then hoping for a technological miracle where we can suck carbon dioxide out of the atmosphere again, that's simply not going to work. Once you've got the momentum in the system, like a steam locomotive thundering down the tracks, it's going to keep going forwards at full speed, even if you throw the wheels into reverse, just because of the momentum. It's not going to immediately stop and go backwards.
Another comment and question. Tanuja, business success is inherently uncertain because of the complexity of business and society's environment. So the question becomes how to generate certainty in uncertainty.
It's part of that. And think of this ergodic investment strategy. I love your question, Tanuja. This is a better strategy for complexity and uncertainty arbitrage. At the moment, our strategies are trying to control and reduce uncertainty, complexity, and risk in individual businesses or by portfolios averaging across all businesses. And this is just a fundamentally better way of harnessing uncertainty and complexity to drive better outcomes.
Okay. Another comment here from Greg. I believe that allocators are open to this type of strategy. First of all, VC is a small business. Fixed income are all over a type of ergodicity. There's so much complexity of decision-making as a fund management company owner, that they take the known path allocators understand. There is a need to develop a common language for the allocators that runs parallel to the fixed income. Good luck.
Yes, absolutely. This is in many ways a paradigm shift, a fundamental paradigm shift of epochal nature. And that does need a new language. It does take time. And a big part of this is most people derive their sense of identity and self-worth from their work and from their success at work. So anything that is changing the strategy that has led to the success they perceive and hence their identity is going to be defended against as an existential threat, not just a new tool in their toolbox to deploy from the same identity. It's bringing in a very different relationship with uncertainty, risk, and complexity.
Philip, I want to pose a question. Why do you think investors are not doing this at this time? At this moment, sorry.
Yes, two big reasons. The biggest one is simply they don't know about it. Those who are beginning to know about it often don't know about it deeply, because at the center of it, this is a question of what is the right mathematics or statistical equations to use. And so a lot of people have negative experiences with maths and statistics, and so get to know about it, but say, I'll look at this next year. And the final one is what I mentioned a moment ago, that sense of, oh, yes, this is very interesting, but I'm not actually going to start doing anything with it because, and they don't realize that this is what's happening because for me, this is an identity level threat. It's a little bit like Kodak invented digital photography. They took out the first patents on digital photography, but they could not develop a digital photography business until it was too late, because their identity was as a chemical photography business, not a digital photography business.
Having been working for the last 30 years and trying to change the financial system so that it works for all stakeholders, it's struck me that if you're extractive in nature, in mentality, you're never really going to be able to embrace ergodicity.
Yes, there's a lot of validity in that point. And it comes let's take a couple of scales there. If you're coming in and your nature is very much that of a gambler, an extractive gambler, or your nature is that of a narcissist, whether you have full-blown clinical NPD or not, this is not something that you're going to get involved with at all. It's just contrary to what energizes you and your nature. A lot of people, though, they're self-interested, but fall short of full-blown narcissism or full-blown high-risk gambling, either make it big or die in the attempt. And this is where, for example, professional poker players sit. In professional poker playing, the extreme typically collapses quickly. You find this in nature as well. Animals that are extremely greedy, narcissistic, they tend not to survive. Sooner or later, a parasite or a predator comes along and takes them out again. It's in the second layer that this is really powerful, because what this ergodic strategy does is it connects self-interest and collective interest.
Mm.
It's a deep explanation for why human societies are so collaborative without recourse to altruism, because it shows that if you understand, and human beings do understand intuitively, how life progresses and the dynamics. And this goes, one of the oldest ergodic strategy statements goes back to the writings of Abraham for how to construct an economy. Those writings had an insight into the non-ergodic dynamics of business, of an economy. So in that sense, what this is doing, collaboration, altruism, at least part of it is well explained by saying, if somebody is trying to maximize their self-interested or maximize their self-interest in a non-ergodic world, they will have high levels of cooperation, resource sharing, collaboration with competing people in their community or competing businesses in their local economy.
I promised I would keep it to an hour. We're going over the time. I'd like to kind of get to a conclusion. What are your final thoughts that you want to share? And secondly, how can we help you?
So in terms of a final thought, is this whole question of ergodic versus non-ergodic processes in life. Is the more that I've dived into it, the more I see areas where my way of looking at the world changes completely. It tips things on its head. And so, I'll leave that thought with you. It's paradigm changing across every paradigm that I've touched so far in my working life and in my personal life. So I'd encourage everybody in terms of how you can help me is, at least get hold of a copy of my book, start reading it. When you find that the mathematics is getting a bit too difficult, come along to whichever of our workshops
Mathematics will definitely become too difficult. I can tell you now.
That's cool. It does for most people. Unfortunately, the maths is a bit unavoidable.
Fortunately, there's
As
a bunch of nerdy people in the live session here, so they can probably deal with it. I can't.
Yes, exactly. Some of the nerdy people definitely can. Most people can't. And this is one of the reasons why it's not so big. So come along to whichever of our trainings, workshops is appropriate for you. And what would be really helpful is as I say, we're in the process of starting up an investment fund to fully deploy this and really give a show me kind of working example. And so we're looking for LPs, angel investors, family offices, etc., who are interested in putting in an initial amount of seed capital so that we can accelerate what we're doing at the moment with the startups we're working with in our accelerator program.
So you haven't told your wife you're a secret billionaire?
No,
Okay.
I
I hope she
haven't.
doesn't look at this. She'll find out.
Well, you know, that gets more interesting in the sense of she's very supportive of what I'm doing. B, she does have hope that this will turn to big success in the not too distant future. And I know that she's supporting this because we got divorced a long time ago, but have been living together for the past 7 years now. So,
Okay.
I regard that as a high level of commitment and sort of mutual support that, we're supporting each other despite having got divorced a decade and a half ago.
Okay. The replay, it takes a little while to process it, so it'll be available probably in an hour or so. And so everyone who registered, I'll send them a copy of the replay and a link to you, and you can also share that, and we'll push out the replay to our wider network of individuals in the weekly and things like that. So, Graham, thank you so much for pursuing your big purpose and staying the course no matter what. And thank you all for coming. And I appreciate all of the effort you do. And let's all be non-extractive in our interactions.
Wonderful. Thank you, everybody. And thank you, Robert, for hosting me so well.
My pleasure. Stay well. See you all soon.
Thanks
Bye-bye.
all. Bye.